and welcome to yet another very special crystal ball. It's been a tremendous run for India compared to most peer markets, and it appears that the market's in no mood to relent before the first union budget of this government. What are the expectations like, and can India still continue to outperform its global peers from here on? Timothy Moe of Goldman Sachs joins me with his views. Tim, very good to speak to you again. What's the mood on India right now after such a brilliant run since the start of this year? From here on, are global investors still optimistic, or are they beginning to turn a bit cautious?
Well, first of all, thank you very much for the invitation. It's great to be back and speak with you. I would say that the mood from global investors is optimistic, and I think probably incrementally more so. And I guess we can base that upon two things. Number one, we have seen continued foreign net buying in the market, certainly since the election results, which would be proof positive that on balance people are still optimistic. And then secondly, from an impressionistic standpoint, in terms of the large number of investors that we speak with on a continuing basis, certainly the mood we picked up before the election, and this, by the way, was part of the reason why we were positive going into the election, was that people were a bit skeptical on things. And now that there's been such a convincing demonstration of the mandate that Mr. Modi has achieved, I think people's view has actually shifted incrementally more positive on a fundamental basis.
Would you say India is a crowded trade right now, or do you think people are not positioned that aggressively? Maybe some of the talk is positive, but it's not a very over-owned destination or asset class yet.
Right. That is a terrific question, and I think there's a really important point to observe here, which is that you have to base your composite judgment on which particular universe of investors you're looking at. So many people have opined that foreign investors are very overweight and exposed to India, but that's based off a fairly small subset of investors, namely the mutual fund investors whose brief is to invest purely in Asia. And based upon the data that we have and that's publicly available, that would suggest they're about 500 or 600 basis points overweight their index, which is quite a substantial amount. However, if you look at a broader array of investors, and this would include global investors as well as broader emerging market investors, and you look at the overall positioning, we think that based upon that larger group of investors, they're only overweight by maybe 100 basis points, which is basically nothing. So if you look at a broader pool of foreign investors, we think that there still is plenty of room for people to increase their allocation to India. And then, of course, the flip side of the coin is you need to look at the domestic investors. And here, of course, retail investors as well as what we call the longer duration investors, which would be the insurance companies and so forth. They've generally been very underexposed to the market and are just beginning to come back in the last several weeks. So putting all that together, we would say there still is plenty of evidence of further money being able to come into the market, assuming that the fundamentals continue to improve.
Local investors still continue to be a bit leery of the market, of equities generally, but the point that you were making about global investors or global funds, do you see a growing awareness in them that they should now probably up their weightage towards India a little bit, or are they put off by the kind of serious run-up that we've seen in valuations in most of the large cap names?
Yeah, I mean, our sense, and we've been trying to be as clear in our view as we can, is that the fundamentals in India are clearly improving, and this is the intersection of politics and policy and the economy. And we think we are literally at the beginning of the upturn in terms of the macroeconomic cycle and in terms of the improvement in earnings. So the market, of course, has done well, as we know, and valuations have expanded, but they're not at extreme levels or levels that would cause undue concern. So if we have indeed an improvement in fundamentals and we think there will be some perhaps upgrading of people's expectations, then we still think that there is fundamental appeal to the market, and that is justification for investors who've maybe been cautious, understandably, and have been on the sidelines to begin to re-engage. So our expectation will be that we will see some further broadening of ownership on the domestic side of the market, both in terms of retail investors through mutual funds and directly, as well as some of the longer duration investors that I mentioned just a moment ago, notably the life insurance companies.
I'll come back to India in a bit, but would like your views on the global backdrop, Tim, because it's been unusually calm 6 months for global markets with the very minor corrections from time to time. Globally, volatility is quite low, as we see in the VIX. Do you see anything sort of roiling this calm in the second half of the year, either coming from Europe or China, which might be material for India as well in terms of market performance?
Well, it's a terrific question, and thank you for asking that, because this is probably one of the highest topics of debate and focus within the global macro community, and I've just had some discussions on that early this morning, in fact. Now, I think we can say a couple of things. One is that volatility is very low, but it certainly seems that central banks, and including most recently the ECB, given its decision last night, are in a policy mode of suppressing volatility. So as long as rates are staying low from a policy standpoint, which we think continues to be the case for the Federal Reserve, for the ECB, of course, given last night's developments, and then also for the Bank of Japan, that certainly from a developed market standpoint, the central bank policymakers are effectively suppressing volatility. Now, there was some commentary from the Federal Reserve that maybe the market's getting a bit complacent about that, but frankly, the market is taking its cue from what the central banks are doing, and at least from that perspective, it seems that things will at least be protected in terms of any sharp surprises in the near term. Now, in terms of China, which is a subject of great discussion and debate, and we don't have time to go into the detail on that in this call, our composite view is that right now China's policymakers are looking to moderately ease policy. I was just in Beijing last week, and so I'm fairly fresh on this, and both from a fiscal, monetary, and administrative perspective, there's clear signals that incrementally policy is being eased in order to make sure that growth achieves at least a threshold level of 7 or a little bit above 7% growth for the full year. So I think our baseline expectation here is that we will have a reasonably constructive growth environment, and that will be something which will be favorable for asset markets in the second half.
What is the danger, Tim? Because right now things are quite good locally in India, so the worry is that something blindsides this market in the second half globally and this uptrend gets vitiated. Do you have any fears at all that people who are talking about a benign second half are probably extrapolating 6 months of calm, and something might provide some shock in the global space which might abort this rally prematurely? What would you say is the risk of that?
Yeah, well, put it this way. I mean, we always have to be alert to downside risks, or what you would call left-tailed risks or surprises. And I don't want to give you the impression that we are not thinking about that actively or concerned about possibilities. I'm giving you our aggregate conclusion, which is still a constructive one. But I think if we're looking at areas of risk, there would be that there is a potential for the market to become concerned about rising interest rates. So, for example, policy rates, which I was just describing, we think will still stay low. But, for example, the 10-year Treasury bond yield, which has rallied, or yields have come down from about 3% at the beginning of this year to roughly 2.6 currently, we think that 10-year Treasury yields will start to move back up in the second half once the market becomes more convinced that growth in the United States is getting back to roughly a 3% level. Now, if that's the case, then that might put some pressure, as it did in the second half of last year, on some of the more vulnerable emerging market economies. And indeed, in the last 2 weeks or 3 weeks, we've seen some of the currencies of the previously designated Fragile Five group, and this would include Brazil and Turkey and South Africa, some of those currencies have begun to weaken. So I think that if we're looking for areas of risk in the second half, one credible source of concern might be rising 10-year bond yields in the United States and the ripple-on effect to some of the currencies in the emerging market domain that have rallied perhaps a bit above their fundamentals. Now, from an India-specific point of view, we would be less concerned than, for example, in the case of Brazil or South Africa. And the main reason is that we think that the policy response and the macroeconomic response which has taken place in India has been more forceful and more credible, and the difference between where, for example, the Indian rupee is trading versus its fair value is much less than the difference between, for example, the Brazilian real and its fair value. And what I mean specifically is that we think the real is a little bit overvalued right now, as is the Turkish lira, and we see there's a good reason for them to drop, whereas the Indian rupee has rallied, but it's pretty much around fair value, which we calibrate roughly around 60 rupee to the US dollar at this point.
Time for a quick break on Crystal Ball. We'll return with Tim Moe of Goldman Sachs in just a minute.